Hi, I thought I would give you some insight into the terminology that we'll be learning dealing with corporations. And corporations sell ownership in their organizations by issuing stock. Every corporation has to have common stock. Some corporations also have preferred stock, and then they have classes of common and preferred as well. Common stock is the mandatory stock that each corporation has to have, and these common stockholders have one of the major advantages of voting rights, meaning that they get to attend national annual stockholders meetings and get to vote on policies and procedures. They also get to vote on members of the board of directors. The common stock also has something named preemptive rights, and what preemptive rights mean, if that I own 10% of a company prior to a new issuance of stock, they allow me to buy enough shares with the new issuance to keep that same 10% ownership. So if I had 10 shares out of 100, or a 10% ownership before they issue 100 new shares, I could then have the opportunity to buy another 10 shares, so I'd own 20 out of 200, and that would be my same 10%. Common stock gets to share in dividends if the dividends are large enough to pay the preferred stockholders first, and there's enough left over for the common stockholders. They also get to share in liquidation. They are the last in line to get paid, however, so they may not get much on the dollar as far as return on investment. They also have the ability to transfer ownership easily, meaning that all they have to do is sell their shares of stock. Preferred stock is a secondary class of stock, and it has preference, so it usually costs more and usually has a percentage return on investment. This percentage return is expected. It is not mandatory. No corporation has to pay dividends ever. The preferred stock can be callable, meaning that the corporation, at its decision, can call these shares back in as they have an expected interest or return rate, and retire these shares and then issue new preferred stock with a lower expected return rate. Convertible means that the stockholder himself can decide to convert his shares of preferred stock into shares of common stock. And that convertible ratio will be given when you buy the stock, meaning, for example, you can exchange 2 shares of stock for preferred for 4 shares or 5 shares of common. Cumulative or not means that the dividends that the preferred expects to get, if not paid, will be held in arrears. These are not a liability but a footnote disclosure in the financial statements, and if they're not cumulative, any dividends not paid to preferred are lost. The participating feature means that if the dividends are big enough that preferred gets any dividends in arrears, which are always paid first, they get the current expected return on their investment. There's a matching way to reward common, and then any excess dividends are then split according to some pre-approved plan between preferred and common. If it's not participating, once preferred gets any dividends in arrears in the current year expected return, they don't get anything else. Note that dividends in arrears are not a liability. Only dividends become a liability when the board of directors declares a dividend. These are a footnote to the financial statements, so they are disclosed to potential investors. Once again, a preferred gets preferences in dividends and liquidations, meaning they get paid first. Dividends, there are 2 kinds. We have cash dividends and stock dividends. Cash dividends reduce retained earnings, and they also reduce total stockholders' equity. The other side of the journal entry, besides a debit to retained earnings, would be a credit to dividend payable, and eventually an asset will be used, cash, to pay off these dividends payable. So cash dividends will reduce both retained earnings and total stockholders' equity. Whereas stock dividends don't involve cash, they involve issuing new shares of stock. While they do reduce retained earnings, because all dividends reduce retained earnings, they also increase paid-in capital, which is the other part of stockholders' equity. So if I decrease one part of stockholders' equity and increase the other part by the same amount, there's no total effect on the stockholders' equity. The result of an issuance of stock is a new account called Stock Dividend Distributable. It's an equity account, it's temporary, and it will eventually become common stock when the dividend is finally distributed.